Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. The good news on the inflation front continues in India. Days after retail inflation dipped below the crucial level of 6%, wholesale price index WPI based inflation has now eased to a 21-month low. This is for the month of November. Falling inflation in India comes at a time when global inflation also seems to be moderating. The latest reading of inflation in the United States, the United Kingdom, and the Eurozone is leading to that big question. Is the worst of the recent inflationary spike behind us, and has the inflation dragon been tamed? Joining us on this subject is Sujan Hajra, the Chief Economist and Executive Director at Anand Rathi Securities. Sujan, welcome to BTTV. My question to you really is, are we reading too much in the numbers, including the latest WPI print that we have seen of 5.85% versus the same month last year, which was a very high 14.87%?
Yeah, a bit of it, a bit of that, a bit of it in the sense the the high of the inflation is looks like it's behind us. But having said that, there is no reasons to expect that every month going forward inflation will go down from the successive month, because in some months you will see inflation going up over the previous month. But the worst of the inflation, as far as India is concerned, is over, and most likely it's over for most of the countries. But having said that, even at the current level, both in India and in other countries, the inflation remains significantly elevated from the over the long period average.
Okay. Why would you say that? In effect, what you are really saying is that we shouldn't start celebrating right yet. The football matches are a different matter. Inflation doesn't deserve that kind of celebration. Is it because core inflation remains sticky? In the context of WPI, if you could provide some granular insight.
Oh, so the basic difference between WPI and CPI is, apart from the higher weightage of food in CPI, is WPI contains only manufacturing and primary products. It basically does not contain services. So that's the main difference between WPI and CPI. Now, coming back to the point, the major part of the volatility which happens in terms of inflation is mostly because of food inflation. So now this food is notoriously volatile. And since food is notoriously volatile, that's why, and food has a very significant weightage, particularly in CPI. That's why I'm telling that it's not a given thing that every month the inflation will continue to go downwards, but the trajectory certainly is downwards.
The trajectory is downwards. If the trajectory is downwards, what are your own month on month readings, at least till March, if not beyond that?
My sense is that by March, our CPI inflation will come down below 4%, and the fall can be significantly more for WPI, because the base for WPI is extremely elevated, and we have seen with the input prices coming down, WPI can soften faster. In fact, for the current month also, WPI is marginally lower than CPI. So WPI can fall significantly. So basically, we are telling it will be even lower than the midpoint of RBI's target, that which is 4% by March.
If I heard you right, are you saying that WPI will be lower than 4%, which is the benchmark that you just mentioned for CPI?
My sense is that WPI will go into negative inflation, which is called deflation, during a significant part of 2023.
Okay, that's a very good point that you make, and let's take that forward in terms of its impact. If wholesale prices are to be in deflationary territory and consumer prices, because of the margins that get added on, remain below the 4% level, which is the RBI's threshold target really, what does it mean for different key aspects that really get impacted? starting with interest rates. What do you feel is likely to happen to interest rates and the cost of money in India?
So far as the policy rate is concerned, RBI is either completely done with rate hike, or our sense is that at most another 25 bips rate hike is possible, though that's also not given. And if you look at the transmission of the policy rates in the debt market, particularly on the shorter end of the debt market, the money market and the short-term government securities, the transmission has been very significant. But having said that, if you look at in the credit market, that is in terms of deposit rate and deposit rate and lending rate, the transmission has not been particularly significant. So my sense is that the debt market, the highest rates in the debt market is already behind us. But in the credit market for lending and deposits, some level of increase can continue, especially because currently, if you look at the deposit growth rates are significantly lower than the credit growth rate. So the banks are in need for money. So if they are needing money, they might have to increase the deposit rates. And if they increase the deposit rate, they might increase the lending rate as well. So my sense is that so far as the bond market is concerned, the worst is behind us. For the credit market, some more modest increase in interest rate is possible.
Okay, just before I come back to that point, on an aside, really, you spoke about transmission, and this is something that in the past, till the RBI changed certain policy levers, transmission was always the issue, and we used to talk about 6 months, 9 months lags also in terms of the transmission. How significantly has this changed, and more importantly, would it be safe to call this as a new sort of milestone that has been reached with regard to monetary policy and its impact on prices?
Now, see, the point is that while we talk in broad terms, we talk about monetary policy, but there are two components of the monetary policy. One is the interest rate policy, other is the liquidity policy. Now, in terms of interest rate, when your RBI is raising rate, basically RBI is raising the short-term interest rate, mostly the overnight interest rate. Now that automatically doesn't get transmitted into a higher maturity, but there is a mechanism through which it gets transmitted. Now, in a system, when you are increasing the policy rate, if the liquidity is in surplus, which is the case right now, then the transmission gets somewhat hampered, because ultimately, what is interest rate? Interest rate is the price of liquidity. Now, if liquidity is in surplus, that means the supply is more than the demand. If the supply is more than the demand, then basically the price should go down. So in this case, interest rate should go down. But at the same time, RBI is raising the policy rate. So therefore, RBI is trying to push the interest rate up. So they counterbalance somewhat, and that's why the transmission gets impacted, particularly in the credit market. But in the bond market, the impact happens slightly differently. So my sense is that so long as liquidity is in surplus, the transmission of monetary policy rate, particularly in the credit market, will be impaired. And we have not only now, it has happened in the past. So from that perspective, it's not very surprising that the transmission has been rather muted in the credit market.
Okay. Let's talk about another aspect that impacts pretty much everyone, which is the exchange rate. We saw the WPI number perhaps being read through and some response when it comes to the exchange rate. What do you foresee happening to flows over the time frame that we have been discussing about? And do you have a exchange rate number that you can share with us?
See, what is happening is that if you look at the interest rate differential between India and rest of the world, or inflation, let's look at first the inflation differential. The inflation differential has come down very significantly. Even before the US or UK inflation going above India's inflation, the differential came down over the last 20 years from 7% to about 2%. So, and if you look at the end of the day, the depreciation of a currency is somewhat linked to this inflation differential. So, consequently, we have seen, particularly up from 2014 onwards, the extent of rupee depreciation has slowed down significantly. Rupee actually remained pretty stable. But during the pandemic, there was some other dynamics. If the interest differential between India and, for example, say US is high, then the more flows are likely to come into India, and at the same time, the currency can also get impacted. Our sense is that in the past, on an average, rupee has depreciated anything between 3 to 6% vis-a-vis US dollar. The rupee has appreciated significantly against other currencies in the recent past, last 1 year. Going forward, also, our sense is that 3% plus minus is the range within which rupee will move vis-a-vis dollar, and the bias is obviously more towards depreciation than appreciation.
Okay, let's take a look at the global scenario for inflation, and this is significant, viewers, from the point of view of what will happen to global demand and in turn for Indian exports. We have already seen IIP data seeming to reflect some of the lower demand that we are seeing globally, and while we can talk sectorally, what I want to ask you is your own reading about global inflation, and with that question, that has inflation peaked in the advanced economies, including the United States, the UK, and the European Union?
While we look at the global inflation, what we see, say, for example, let's talk about the G20 countries, because that ultimately accounts for 85% of global output and about 90% of global trade. If you look at the G20 countries, almost all of these countries, with the notable exception of China, almost everybody is currently sitting at inflation which is higher than long period average. But having said that, if you look at the OECD countries, most of them actually faced in the last few months the highest inflation in between 2 to 7 decades. But if you look at the emerging market countries, whether China, whether Indonesia, whether India, whether Brazil, whether Mexico, none of us faced even a decade high inflation during this phase. So basically, inflation has been more of a rich man's problem. Now, it has been more of a rich man's problem because apart from easy monetary policy, they have given, which they followed, in fact, since the global financial crisis. So for the last 15 years, they gave a huge amount of fiscal stimulus. In certain quarters, the fiscal deficit to GDP ratio in UK crossed 25%. In US, it came very close to 20%. In Canada, in Australia, it was closer to 14%. So, given the size of the fiscal stimulus, so therefore, obviously, on the demand side also there was pressure in prices, while the emerging markets did not give so much of stimulus. Consequently, the inflation went up in a relative sense far more in the developed countries than in the emerging market countries. Now, with the tightening of monetary policy and also withdrawal of fiscal stimulus, inflation is coming down everywhere. My sense
Okay.
is that even US in some point of the time in 2023 will go into deflation. So at least for the next 12 months, the outlook for inflation globally is that it's going to trend downwards, and it's perhaps going to surprise us more than whatever decline we are expecting right now. The actual decline can be more than that, as happened yesterday in US.
Sujan, when we overspeed on a highway and then we start slowing down, at some point we need to press the foot on the accelerator again and try. If we try and use that analogy when it comes to growth, what does it mean for global growth? Because till about a month back, the sense of pessimism on global growth and obviously India's growth for 2023, I personally feel that we may perhaps no longer need to be so worried. Am I reading the right part of the interpretation, or are you reading something else?
No, my sense is that so far as the global growth outlook for 2023 is concerned, it's my expectation is certainly better than what the consensus is expecting or was expecting. So I think the global growth will be stronger than what is being anticipated by most. One component of across countries where the growth rate is very high is the fixed investment. Almost in all countries, the fixed investment is accelerating, and its fixed investment to GDP ratio is significantly higher than the pre-pandemic. So that is one component which will be a big positive. But having said that, as you pointed out earlier, a big drag will come from export side. Because basically the foreign trade is cooling off, and that will be a drag. And also, as countries do fiscal consolidation, that will also be a drag. So I think it's a foregone conclusion that the Europe, many countries in Europe will go into recession or negative output growth. But I don't think either US or the overall global economy will go anywhere close to recession.
Okay, which really seems to tell me that if things were to worsen, you would once again see all the governments in these advanced economies trying to get growth back up, and they are pretty quick when it comes to opening the stimulus taps. Uh, let me conclude this conversation by asking you, as an economist, you what do you expect to happen when it comes to India's stock markets? We seem to be bucking trends repeatedly. One of the key milestones that we will see is the union budget. But broadly speaking, do you have a view on the markets as well?
See, ultimately, if you look at in the medium to long term, the equity market moves on only three things. First is fundamental, both macro fundamental and corporate fundamental. Second is liquidity, how much money is getting into the equity market, both from domestic sources and foreign sources. And lastly, valuation. So far as the macro fundamentals are concerned, India presents one of the best macro fundamentals globally. So far as the corporate fundamentals are concerned, corporates are actually doing better than the overall economy. So far as the domestic liquidity flow towards the equity market is concerned, we haven't seen a better period in the last 20 years, 30 years than what's happening with the monthly SIP amount crossing 13,000 crore. That is about 20 billion a month annualized basis. So domestic liquidity is extremely buoyant. So far as the FII flows are concerned, whenever there has been an outflow from India, as happened in 2008, 2011, and 2018, the next couple of years, on an average, we get $20 billion of inflow. So if the foreign flows also pick up, that also can be a big factor. Lastly, if you look at the price to earnings ratio of Nifty 50, and I'm not talking about a forward-looking basis, I'm just looking at the trailing 12 months. Today, Nifty is trading at 22 trailing PE. The average between 2015 to 2021 has been in excess of 26. So while Nifty may not be very cheap, it's not very expensive either. So looking at the fundamental liquidity as well as valuation, I have a positive view about the Indian equity market. My sense is that 11 to 13% return over the next 12 months is something which is very feasible.
11 to 13% return over the next 12 months is feasible, and that, I think, is the best last word on today's conversation, because all the macro numbers ultimately come down to how it plays out with regard to returns. Sujan Hajra, I enjoyed this conversation. Thank you very much for your time, and hope to see you some other time once again to discuss the macro as well as the micro. With that, it's a wrap on this conversation. We'll be back with more. Do stay tuned in.